imagine you want to measure the size of a country's national debt, right? You look at the official ledger, and you're expecting just a single straightforward number.
Right, like balancing a checkbook. You just want the bottom line.
Exactly. But what if I told you that depending on who you actually ask, Brazil's national debt is currently sitting at 81.9% of its GDP, while literally at the exact same moment, it is also sitting at nearly 96% of its GDP.
Yeah, it's wild. It's this multi-trillion real mystery.
It is. It's this massive statistical divergence, and, it has these profound real-world consequences for the entire economy.
Well, because when we think of national accounting, we usually picture this like rigid binary system. But when you're dealing with the institutional perimeters of a massive emerging economy like Brazil, the architecture gets incredibly complex.
It really does.
I mean, how you define the actual borders of the government basically dictates the size of the debt you end up reporting.
Definitely. And before we get too deep into those borders, I should mention today is Saturday, August 22, 2026, and the research and data collection for this deep dive was actually completed yesterday, August 21st, 2026.
Hot off the presses.
Exactly. You are listening to Macroeconomy AI, and today's deep dive is titled Brazilian National Debt. So thank you to all of you out there for tuning in and bringing your curiosity to this discussion.
We definitely have a lot of ground to cover today regarding how, these macroeconomic systems actually interact with each other.
Oh, for sure. But really quick, before we begin, we have a short message from our sponsor. We are proud to be representing channel Macroeconomy AI, bringing a compilation of analyses and news on macroeconomics, technology, and artificial intelligence.
Which is super important right now.
Right. By subscribing, you get access to these data-driven insights that really cut through the noise, helping you understand the forces shaping the global economy. So check out the links in our description to learn more.
Awesome. So our mission today for this deep dive is to essentially unpack the Brazilian public debt ecosystem. And we're going to be using that fresh June 2026 data.
Right.
We'll explore the architecture of the national treasury, the central bank, the, frankly, compounding impact of interest rates, and, the strategic risks that this specific debt profile poses to the broader economy.
Yeah, so let's just start with the baseline size, because looking at that June 2026 data, the raw nominal value of the federal public debt, or the DPF, is just massive.
It's huge.
But when we try to express that raw number as a percentage of the country's gross domestic product, we run straight into that statistical divergence I mentioned at the top of the show.
Yeah, so the federal public debt, it reached 9.268 trillion reais in June 2026.
Wow.
Right, and that is just the absolute raw value of the government's borrowing. But the divergence happens when you try to actually calculate the general government gross debt, the DBGG.
Right, which is where things get tricky.
Exactly.
Yeah.
Because the Central Bank of Brazil, the official domestic authority, they place this figure at 81.9% of GDP.
Okay, so just under 82%.
Right. But, however, the International Monetary Fund, the IMF, they use a totally different conceptual framework. Under the IMF concept, which is, the one widely cited by the international press and global projections, the debt sits at 95.8% of GDP.
That is a massive jump.
It is. And the Brazilian Court of Audit, the TCU, they've actually been pointing out this growing gap throughout 2023 and 2024.
It feels like stepping on two different scales at the doctor's office, right? And getting vastly different weights depending on if the doctor decides to include the heavy winter coat and boots you happen to be wearing.
That's a great way to put it, yeah.
Because both scales are calibrated and working perfectly, right? They are simply measuring two totally different parameters. So my question is, why does this gap exist in the methodology? And what happens when domestic reports operate on an 82% reality while international investors are staring at a 96% reality?
Well, the discrepancy is entirely about what we call the institutional perimeter. So the Central Bank of Brazil, they define the general government gross debt using a specific, much narrower boundary.
Meaning they don't count everything.
Exactly. They include the federal government, the social security system, the INSS and state and municipal governments. But they deliberately exclude the central bank's own portfolio and state-owned enterprises.
Oh, I see.
But the IMF, conversely, they apply a standardized global methodology because their goal is to allow an apples-to-apples comparison across 190 different countries.
Right. They need everyone on the same standard.
Right. So to achieve that standardization, the IMF's perimeter is broader. It scoops up more of those peripheral liabilities, essentially weighing that heavier coat in your analogy to ensure that, hidden debts aren't being masked off the main balance sheet.
Okay, so the IMF basically applies a universal template, even if it directly conflicts with the country's own domestic accounting laws.
Yes, exactly. And the strategic risk here, it basically revolves around perception, capital flows, and risk premiums. Global finance relies heavily on clean, comparable data.
Of course.
So if you are, say, an international credit rating agency and you're comparing the sovereign risk of Brazil to, like, Mexico or India, you are absolutely going to use the IMF's 96% figure.
You're not going to use the domestic one.
Right. But domestic policymakers, they often communicate their fiscal targets and their successes based on the 82% figure. And this creates friction.
Yeah, I can imagine. Because foreign capital might feel like they're being misled, right?
Precisely. If foreign capital perceives that a government is understating its leverage compared to international standards, well, investors are naturally going to demand a higher risk premium to lend money, simply because the data requires a translation guide. It introduces this layer of opacity into the sovereign bond market.
That makes total sense. And if the baseline data requires that much interpretation, I kind of want to look at how this 9.2 trillion real debt is actually structured.
Yeah, let's get into that.
Because based on our sources, the raw size isn't really the primary concern, right? The composition of the debt is where the real fragility seems to lie.
Oh, 100%. The absolute size of a country's debt is only one piece of the macroeconomic puzzle. The profile of that debt, meaning like the cost of the capital, the timeline to repay it, and how the interest is actually calculated, that dictates whether a sovereign balance sheet is sustainable or just highly vulnerable to external shocks.
Right.
And Brazil's debt profile right now is it's structured in a way that leaves very little margin for error.
Well, looking at the June 2026 data, the average cost of the federal debt is sitting at 12.68% per year.
Which is high.
Very high. And the average maturity, like the timeline before the government actually has to refinance or pay back the principal, that's only 4.01 years.
It's a really short leash.
Yeah, but the metric that stands out the most to me is the reliance on floating rates. I mean, I'm seeing here that nearly half of the debt is tied directly to the benchmark interest rate.
Yeah, specifically, 49.32% of the debt is composed of post-fixed bonds. In Brazil, these are primarily the Letras Financeiras do Tesouro, or LFTs.
Okay, LFTs.
Right, and these bonds, they do not offer a fixed payout. Instead, their yield basically floats directly alongside the Selic rate, which is the central bank's foundational interest rate.
Wow. So almost half of the country's national debt basically operates like an adjustable rate mortgage?
Yes, exactly like that.
So every time the central bank moves the Selic rate, the Treasury's cost of carrying national debt just changes instantly.
It does, and it creates this brutal macroeconomic feedback loop. You see, the Central Bank of Brazil operates with a primary mandate to control inflation.
Right, that's their main job.
Exactly.
Yeah.
So when inflationary pressures rise in the broader economy, the standard monetary policy response is to raise the Selic rate. This, makes borrowing more expensive for businesses and consumers, which cools down demand and theoretically brings prices back down.
Makes sense on paper.
But because half of the government's own debt is tied to that exact same Selic rate, raising rates to fight inflation immediately explodes the Treasury's debt servicing costs.
That is wild. And the numbers in the first half of 2026, they show exactly how this plays out, don't they?
They really do.
Because the total debt grew by 633.3 billion reais in just 6 months. But over 80% of that growth, like 521 billion reais, that came purely from the appropriation of interest.
Just the interest alone.
Yeah. It wasn't driven by new primary spending like, infrastructure projects or public health initiatives. The debt grew by over $500 billion simply because of the cost of carrying the existing obligations.
And that means the central bank is forced into this position where defending the purchasing power of the currency inherently damages the fiscal health of the Treasury. It acts as this massive transfer of wealth from the government to the bondholders.
Which is so different from other countries, right?
Oh, completely. In many advanced economies, sovereign debt is locked in at fixed long-term rates. Like, if the U.S. Federal Reserve or the European Central Bank raises rates, it only really affects newly issued debt, not the entire existing stock.
Right, because the old debt is already locked in.
Exactly. But in Brazil, a 1% hike in the Selic instantly translates into billions of reais in new debt. And, the historical context here is super important.
Oh, how so?
Well, Brazilian investors, they demand these floating rate LFT bonds because of the country's history with hyperinflation in the 1980s and 90s.
Oh, that makes total sense. They've been burned before.
Exactly. Investors are deeply wary of locking their capital into a fixed rate for, say, 10 years, because they are terrified that inflation might suddenly spike and just erode all their real returns. So the floating rate bonds, they are a defensive mechanism for the investor, but a massive, massive vulnerability for the state.
Wow. So if interest payments are basically automatically driving up the debt by hundreds of billions of reais, how is the government managing the spending that it can actually control?
That's the million-dollar question, or I guess trillion real question.
Right, because the legal framework governing the Brazilian economy has gone through major changes recently, specifically with this new fiscal framework that was meant to stabilize this trajectory.
Yeah, the new fiscal framework. It was enacted as Supplementary Law 200 back in 2023, and it was designed to replace the previous spending ceiling. The core mechanism of this framework is a really strict limit on the real growth of primary expenses.
And primary expenses, just to clarify.
Oh, right. Primary expenses include the day-to-day operations of the government, so public sector salaries, social programs, infrastructure investments, administrative costs. Under this law, the growth of these primary expenses is restricted to a band between 0.6% and 2.5% per year above inflation, depending on the revenue performance.
Right. But when we look at the consolidated public sector results, the nominal deficit over the last 12 months is sitting at 9.99% of GDP.
Yeah.
And the breakdown of that deficit is what's really striking here. Out of that 9.99%, a full 8.88 percentage points come purely from paying nominal interest.
It's staggering.
It is. Only 1.19 percentage points come from the primary deficit, meaning the actual gap between tax revenues and everyday government spending.
And this right here, this exposes the absolute structural asymmetry of Brazilian fiscal policy. The new fiscal framework places a rigid ceiling on political choices. The government can limit its investments, they can freeze hiring, they can hit their primary fiscal targets perfectly.
But the gross debt will still continue to expand aggressively.
Exactly, because the interest burden is entirely exempt from the spending limits.
So wait, there is a strict speed limit on the real economy? You know, the budget that actually affects hospitals, schools, and roads, but absolutely no cap on the financial side of the ledger.
That's exactly it.
The interest payments make up almost 90% of the entire deficit, and the law just simply ignores them.
Well, because you cannot legislate the cost of capital, right?
Yeah.
A government can pass a law capping the salaries of its civil servants, sure, but it absolutely cannot pass a law capping the yield that a foreign investor demands to hold its bonds.
The market just wouldn't accept it.
Right, the market dictates the interest rate. So Brazil essentially operates with this rigid constraint on its primary economy, while its financial obligations remain fully exposed to the volatility of monetary policy. This means the overall debt trajectory can worsen rapidly even during periods of intense political austerity, simply because the cost of rolling over the debt far outpaces the savings generated by any budget cuts.
That is just, it's a brutal cycle. So if the government is trapped in this cycle of issuing high-yield debt just to cover the compounding interest on older debt, who's actually on the other side of these transactions.
The bond buyers.
Yeah, because the institutional design of how this debt is issued and purchased, it seems to involve a very strict separation of powers.
It does. The functions are heavily segregated by design. The National Treasury, the STN, they manage the fiscal side of the equation. They're the entity that actually runs the public auctions and officially issues the sovereign bonds. But the Central Bank of Brazil, the BCB, they manage the monetary side. Under Article 34 of the Fiscal Responsibility Law, which has been in place since 2002, the central bank is legally forbidden from issuing its own bonds.
Wait, really? Why enforce that specific legal separation?
Well, it acts as an institutional firewall to essentially prevent the monetization of debt. In some countries, central banks will issue their own sterilization bonds to manage liquidity in the banking system.
Right, pretty common.
But in Brazil, giving the central bank the power to print money and the power to issue its own debt was historically seen as a fast track back to hyperinflation. So the Fiscal Responsibility Law explicitly separated these powers.
So they have to use what the Treasury issues.
Exactly. If the central bank needs to conduct open market operations like, say, absorbing excess cash from the banking system to keep inflation down, it has to use bonds that were originally issued by the Treasury.
Okay, so the Treasury issues the bonds, but looking at the internal federal public debt, or the DPMFI, the actual investor base buying these bonds is heavily fragmented.
Very much so.
Financial institutions hold the largest share at 31.76%. Pension funds hold 22.52%. Investment funds hold around 22%. And non-residents, foreign investors hold 9.95%.
And the breakdown of what these specific groups actually buy, it reveals how different macroeconomic incentives kind of stabilize the whole system.
Oh, how so?
Let's look at pension funds, for example. A pension fund's entire operational purpose is liability matching. They have to guarantee that a retiree will have enough purchasing power to survive 20 or 30 years from now.
Right, they can't afford to lose to inflation.
Exactly. Their biggest existential threat is inflation just eroding the value of their capital. So consequently, pension funds heavily favor NTN-B bonds.
What are those?
These are inflation-linked bonds tied to the IPCA, which is Brazil's broad national consumer price index. So the bond pays the official inflation rate plus a real interest premium, offering them absolute safety in real terms.
Ah, okay. Meanwhile, I'd imagine foreign investors behave completely differently. I mean, they operate in a global landscape, comparing yields across all these different sovereign markets, so their bond preferences must reflect that, right?
Spot on. Foreign investors are looking for yield that they basically cannot find in advanced economies right now. So they overwhelmingly prefer prefixed bonds.
Prefixed meaning a set rate.
Yeah, these bonds lock in a specific nominal interest rate at the exact time of purchase. So if a foreign investor buys a prefixed Brazilian bond yielding, let's say 12%, and Brazilian inflation subsequently drops to 4%, that investor captures a massive 8% real return.
Wow, so they are taking on the inflation risk in exchange for that high nominal reward.
Exactly. And this diverse investor base, it actually acts as a shock absorber for the Treasury.
Because everyone wants something different.
Right. If everyone in the market only wanted inflation-linked bonds or only wanted floating-rate SELIC bonds, the Treasury would be completely cornered. But because banks need liquidity, pension funds need inflation protection, and foreigners want fixed high yields, the Treasury can spread its risk across all these different financial instruments.
That makes a lot of sense. That diversification is really crucial to maintaining those auctions. But, we also have to place Brazil's internal mechanics onto the global stage.
For sure.
Because sovereign debt expansion is not an isolated phenomenon right now. According to the latest projections from the IMF, global public debt is expected to exceed 100% of global GDP by 2029.
We are definitely entering an era of unprecedented sovereign leverage across the board.
We really are. And the figures for advanced economies put Brazil's situation in pretty stark contrast. Based on the 2026 data, Japan's national debt is hovering around 204% of its GDP.
Wow.
Yeah, the United States is at 126%. France is at 118%. If we take Brazil's IMF concept number, the 95.8% we analyzed earlier, it is notably lower than those advanced economies.
But it remains significantly higher than some of its Latin American peers, right?
Exactly. Mexico, for instance, operates with a debt-to-GDP ratio closer to 60%.
And this is where we have to synthesize the raw data with the structural mechanics we talked about, because a debt-to-GDP ratio just cannot be analyzed in a vacuum.
It doesn't tell the whole story.
Not at all. The sheer size of Brazil's debt is honestly less of a threat than the architecture supporting it. Like, Japan can sustain a debt load of 204% of its GDP because it controls a global reserve currency. Its interest rates have historically been at or near zero, and its debt is held almost entirely by domestic savers.
So they don't rely on volatile foreign capital to roll over their obligations.
Exactly. Japan is insulated in a way Brazil just isn't.
Right, because Brazil doesn't have the luxury of a reserve currency or near zero interest rates. The Treasury is paying over 12% a year just to maintain the debt it already has.
Right, and that is the true fragility of the Brazilian system. It's the intersection of these variables. A high average cost of capital, a short maturity timeline that forces the Treasury to constantly refinance the debt every 4 years, and a massive reliance on those floating rate bonds tied to the SELIC.
So any external shock is just amplified?
Exactly. An external macroeconomic shock, like, say, a spike in global energy prices, or a sudden devaluation of the Brazilian real that transmits immediately into the domestic inflation rate. The central bank then hikes the SELIC to combat that inflation, and the Treasury's balance sheet deteriorates overnight.
It's just a highly reactive defensive posture.
It is. It's a delicate balancing act, and as global conditions shift, that balance becomes much, much harder to maintain.
Which I think leads us to a really critical question regarding the future of international capital flows.
Oh, definitely. Because as global debt races past 100% of GDP by 2029, the fundamental dynamics of sovereign borrowing are totally shifting. The traditional, safe haven premium of United States treasuries is actually beginning to erode. With U.S. debt surpassing 126% of GDP, the American government is increasingly forced to offer higher yields just to attract buyers for its own massive bond auctions.
Right. And if the United States is offering high returns, it acts like a vacuum for global liquidity, right?
Exactly. Capital is a finite resource. If the safest assets in the world, backed by the world's reserve currency, start offering yields that compete with emerging markets, the fight for that capital becomes fiercely competitive.
Wow, yeah.
Countries like Brazil will be forced to offer truly extraordinary premiums just to attract those non-resident investors. And this will only exacerbate the high cost of debt and put further strain on the rigid fiscal frameworks that were designed to contain it.
It's fascinating. The intersection of domestic institutional design, monetary policy, and global liquidity, it just creates this highly complex ecosystem. Understanding how all these forces interact definitely provides you all with a much clearer picture of the risks and realities hidden behind just a single debt-to-GDP percentage.
It really does. But before we conclude today, please remember that this content is strictly for educational and informational purposes, compiling public market data and projections.
Yep.
It contains absolutely no ideological bias. It is not investment, financial, legal, or tax advice. Past performance does not guarantee future returns. Economic projections change frequently, and you should always consult qualified professionals before making any strategic or financial decisions.
Perfectly said. That was today's Macroeconomy AI. We'll leave it here. You all stay well and keep an eye out for our new broadcasts. Subscribe to our channel, access the links, and follow Macroeconomy AI on social media.